is you've had some experience with this, right? And so a lot of these are going to be piggybacking off of some of the stories that you've shared. But Anthony, share with our listeners some of the ways that they can actually go about doing this.
Now, one, like I'd mentioned earlier, is adding them as an authorized user. Now, not that doesn't equate to every credit card, right? And what I found is if there's a separate credit card number,
Mm-hmm.
then that will typically add on to their credit score. But what you'd have to do is contact your credit card, the bank that issuing your credit card, and ask them if they will be reporting to the credit on authorized users. What is interesting is some of them have, well, a lot of the banks have limits. Like Bank of America, for example, you can only put an authorized user once they're 18 years or older. However, American Express and Discover, that age is 13. But there is no age limit for Capital One, Citibank, Wells Fargo, and Chase. But if we are doing this, you have to keep in mind the activity on your credit is going to affect your child's good or bad. So you need to make sure that make sure that you are making your payments.
Great point, right? Is you certainly don't want to be dragging them down. Well done.
Now, the second one is what I thought was very interesting, is that you can open up an account, whether it's a cell phone, a utility, or maybe the internet, in your child's name. Also, that also goes to, you can report if they are renting an apartment. Those typically, all those activities I mentioned, typically activity is not reported to the credit agency unless there is a delinquency. However, you can contact the credit bureau and they will allow that to be reported. Now, Experian, for example, they call it Experian Boost, and we're going to put a link in the show notes, but you can click on there and that'll give you more information on how you can have these some of these utilities and rent payments reported on your credit card. And when your child if they do go to college, one of the things you're going to see at orientation, you're going to see these booths of credit card companies, right? Willing and able to issue your child credit. And so it's not emphasized so much on your credit history or your income. Is, hey, you're a college student. We want to get you in the game and get you part. It's almost like a drug dealer, right? Where they're giving you a little taste at the beginning. Now, again, you have to be very careful. I would say when I got a credit card when I was in college, and there was a little bit of abuse on there. And so we got to make sure that if they are going to get that card, that they are going to be a proper student or a good steward. Because if they miss some payments or mess something up early on, it's going to impact them for a long period of time. Now, another thing you can do is accept the student loans. Now, a lot of people, particularly our clients, are under the misconception that they're not going to qualify for financial aid. Now, they may not qualify what I would say a need-based or a financial need-based or free money. Okay. However, every college student is eligible for a Stafford loan. And I think that first year it's about $5,400. And then each year it gets a little bit higher. So again, I had my kids take that out because I wanted them to have skin in the game. But maybe you want that or not, but there could be some advantages of taking out that student loan so they can establish credit. Now, again, if you're doing IBC, let's say you get that loan for $5,000, maybe you don't need it, but I wonder if there's a place you could put it that could be liquid and maybe you can save interest. So what you could do is maybe you take that loan of $5,000, you got to put it somewhere why don't you store it in one of your policies? Thus, stop accruing interest. And then when they graduate, or as long as you want to take, we could slowly move that money out and repay the loan. Now, we are paying some interest here. So if that's something that is a concern of you, I totally get it, but you have to be the one to determine if that interest is worth the advantage of having the credit score. Another interesting thing that you can do is you can have them co-sign, or you co-sign on either a loan they have, or, which I think would be even better, is have them co-sign if you're getting a car loan. They're not going to qualify from themselves, but if we can get them on the note, they're going to start building credit history. Because ideally, when we're looking at your credit history, we ideally want like a mixture of credit. So we can have some student loans, we can have some credit card, and an auto loan would create a good mixture.
You want to see the entire episode? Click here. If you want to learn how investors use infinite banking to increase their returns and lower their taxes, click here. If you want to see if infinite banking is for you and you have some questions, hop on a discovery call with us and one of our coaches. The link for that will be in the description.